Ta-ta-da-ta-da.
We're so
I'm so excited, you know, it's the first
yes.
time Jay.
Yes, great. Let's begin then. Hi, everyone. Thanks for being with us today. We hope you're doing well, and welcome to our Macro Break webinar, the place where we are sharing updates about the latest news in economics, finance, and investments. As you know, this webinar is hosted by Quantilia, the data management and analytics platform dedicated to wealth managers and institutional investors. And today we have a special edition because we have two speakers from different countries of the world, the experts in finance and global financial markets, Jacques Lemoisson, founder of Gate Advisory, and Jay Pelosky, founder of TPW Advisory. And the subject of our today's webinar is From Rotation to Post-COVID Transition. So I will pass the word to our experts so they could cover the subject and the topic of today. And during this time, you can post all your questions through our system, through the chat, and we will answer them at the end. So thank you, Jay, Jacques. Let's get it started.
Thank you, Katerina. Jay, I'm super happy to have you on board. It's the first webinar together. I pray that it will not the last one.
Yes.
Definitely, it's. I think that we could be very happy to have selected this kind of subject because we just brainstormed 2 weeks ago about what we could share together to our audience, and we decided to say, hey, we talk about rotation. Now we think that there is a transition to the pre-COVID world. I hope this summer. Anyway, in summer in US, we know the case in Europe. On better plans, could be a kind of milestone. Hopefully for us, Biden just announced a part of his new plan, mainly in the infrastructure. For the education, I think we have to wait a couple of days or even a week. And I am very happy to have you on board about the subject. And also we address the rise of thematic investing because it's, I think, something important for you.
Yes, thank you, Jacques and Katerina. Thank you very much. And apologies to the audience. I had a little technical difficulties here in New York, which delayed us a bit, but thanks to the teamwork of the three of us, we were able to get it organized. And yes, Jacques, we did think about this subject 2 weeks ago, and the Biden plan, President Biden is starting to develop a pretty good reputation for delivering on time, and we'll see about whether it's on budget. But certainly for our point of view, and congratulations to you for pulling these slides together so quickly. But I think we're certainly, I think it's an important issue, and look forward to engaging with you and the audience here as we go through some slides and cover some global macro ground. And we do hope to integrate the thematic investing outlook to our global macro. Both of us are global macro guys. We have lots of experience. Both of us are big believers in thematic investing as a way to add alpha. And so I hope it's going to be a great hour for us and for the audience.
It's a good introduction, Jay. I think that we keep the lead now because I put this the first slide. It's a BBB Biden plan. I think, do you have some? I think that our audience are professional, meaning that they know how to read a report. And I think that they already saw what presented your president. Do you have some highlight in these figures to some insight about your observation?
Yes, thank you, Jacques. I mean, I don't really have a specific insights into the figures, but what I do have is a broader picture. And I believe that the U.S. is going through a very important political pivot point. We are exiting 40 years of a government is bad, smaller government is good mentality. going back to Ronald Reagan in the 80s and his famous 9 most terrifying words in the English language: I'm from the government and I'm here to help. So that was the mentality that has really pervaded the U.S. political system for the past 40 years and culminated in the Trump administration and its reason for being, which was the complete deconstruction of the administrative state. And that left us with our COVID response, which was subpar at best. And so now we are pivoting from that mentality to a very different mentality, a mentality that believes, given the huge challenges facing the United States and the globe, COVID, climate, inequality, those challenges coupled with cheap money, whether the 10-year treasury's at 0.9 or 1.7, relative to history, this is extremely cheap money. And so the twin nature of the huge challenges and the cheap money is setting us up for a pivot point in politics in the United States. And I think you can make the case for Europe and elsewhere as well, that as an activist government that is necessary to combat these issues. You can't combat COVID by the private sector itself. You can't deal with climate change simply by encouraging Tesla to make more electric cars. You need to have a government response. And so we have a situation where people are crying out in the United States for government help. And you see that the Biden rescue plan, the prior plan, 1.9 trillion, was one of the most popular political programs in modern American history, had over 70% approval rating. Many of the numbers that you show here in the focus of the Biden jobs plan also poll extremely well across Democrat and Republican voters. And so there is a desire in the U.S. for big government, and you have the Biden government going big, the size is impressive, and going fast. And I think that part stems from the fact that most of the Biden team come from the Obama administration, and they have seen over the last decade what happened because they went too small and too slow.
I have a question as a candid European. What is your thought about the income, I should say, part, meaning the tax? Okay, as I saw very few comments about the income of this plan. Meaning also, I have a feeling that some Republican could try to challenge this plan by, for example, the end of the cap on the salt, on something like that. Do you think this plan could, the implementation on the vote of this plan could be a little bit delayed by some negotiation on the Senate, for example, due to this income part, because it's a huge jump in taxation?
Yes. Yeah, no, I think that's absolutely right, Jacques. And look, though, I also think it's interesting, the fixed income market response, right? Yeah. Everyone's concerned about the rise in rates, right? Or inflation and the backup in treasury rates. And now we have this let's call it 2.5 trillion. You know, we used to talk millions, then billions, and now we're into trillions. I don't even know what comes after trillions. Is it quadrillions? Yeah, I think it's called Bitcoin, actually, right? But I do think that it's very interesting to see the fixed income response yesterday, right? The fixed income market over the last 2 days has rallied. Yields have come down, not gone up. And I think that's a sign that at least the fixed income investment community is happy to see that the bulk of this jobs plan is going to be paid for as opposed to be financed. And so, yes, you're going to have tax increases. It's basically a reversal of the tax cut that was put in place by President Trump. Corporate taxes going back up. As you know, I think arguably they should. Companies have made a lot of money over the last number of years. Profit margins are close to all-time highs. So I think, and again, the stock market too is giving you its immediate reaction. Stocks were up yesterday. Stocks are up strong this morning in New York. And so I think both equity and fixed income investors find a lot to like here. And yes, there will be obviously negotiation and conflict, but I also think that the Biden team recognizes that fixing COVID, and we're now well on our way to vaccinating the bulk of the adult population in the United States and setting off a global economic boom and a boom in the United States is good politics. And so to me, I think the Biden administration has demonstrated both a desire for bipartisanship and a willingness to go it alone if necessary. And I think that it's without a doubt in my mind, at least, that the negotiations are going to be more important within the Democratic Party than across the aisle with the Republicans. And getting all the Democrats on board and passing what can be passed by reconciliation with the majority is most likely the way this is going to turn out. Though, you know, you could see some Republicans come on board simply because, as I mentioned earlier, the polling on this is very, very popular.
Yes, agree with you on. We have to highlight too that next year we will have a midterm election, and I think that some guys, if they want to save their seat, they could be more in favor of this kind of plan. Just I would like to highlight some 2 or 3 stuff before to jump on the other slide, because I don't want to speak on to be stuck in this slide too much long time. It's just about the expenses. I think that what's key is very interesting. It's the electric vehicles are integrated directly in the infrastructure. The second observation, it's the manufacturing subsidies. It's a real interesting stuff, and I will explain more in detail after why I'm liking this point. Mainly when we will dig in the differentiation in the ETF infrastructure construction. You will see that there is some surprise. And also the last but not the least is the broadband. Definitely, it's, and we will discuss later. US infrastructure is important for Gate Advisory because we launch a strategy on this. And definitely, smart city is a key component now of the new infrastructure. And definitely, I designed this strategy in May 2020, and I'm super happy to see that broadband is definitely incorporated in the new plan of infrastructure. And definitely, I think that very few investors are not exposed to this kind of thematic inside an infrastructure thematic. Just this quickly, I extract from my presentation these 2 slides just for the audience. When I build a strategy, I always start from not what the financial guy are printing, but from the ground. Mainly, I just dig in the American Society of Civil Engineers on the infrastructure report card. I think it's just it's more than clear. You can't. It's US infrastructure gets a D+ grade. It got the same grade in 2013. Okay, meaning that it's just a disaster. I put different kind of aviation, bridge, dams, drinking water, energy, everything. Everything needs to be reshaped or upgraded. Also, we have recreation park, schools, road, rails, solid waste, transport, and so on. One thing is very important for me also is that to highlight that this association just compute that the United States will need $4.5 trillion by 2025 to improve the states of all the infrastructure, meaning that the real need of the USA in terms of infrastructure is double the size of the plan announced by Biden. Just to see the magnitude of needs. I'm not American. Do you confirm this kind of magnitude of needs in infrastructure, Jay, on your side in US?
Yeah, I would say two things, Jacques. The first is this is emblematic of small government, right? The mentality I spoke of, 40 years of not spending money and trying to spend less and less and basically spending what money we're spending on defense and other issues and not really focused at home. And so I think this is makes perfect sense to me. And the other point and then the corollary to that though, is I think it's important for the audience, particularly in Europe, to understand that the bulk of the infrastructure work in the United States is done at the state and local level, not really at the federal level. And so there's a lot of back and forth and negotiation and kind of agreement as to how this is going to play out. And that's why the bulk of this plan is over 8 years. So this is not, it's very different from the rescue plan, right? The $1.9 trillion plan. That the focus was to get the money out quick, cut checks, $1,400 per adult. This plan, the jobs plan, is spread out over 8 years because it takes time to move through the federal system to the state and to the local system. So that's point one. Point two, Jacques, I know you and I both have kids.
Yeah.
If your kid brings home a report card littered with D's, I know in my house, that kid does not go out until those D's become A's, right? Am I wrong?
Yeah. Absolutely agree. That's same education, man. It's just
D's are not acceptable grades.
Absolutely.
And again, I think the broadband, you know, hopefully we bring America through this program, you know, into the game. You know, I spend my worldview is tripolar, regional integration in Europe, Asia, and the Americas. To me, this plan speaks to the potential to integrate first within the United States and then increasingly north and south with Canada, Mexico, and South America. And that is critical, in my view, to the future success of the United States and the Americas writ large.
Definitely, I am also a specialist in Chinese stocks about China. Definitely, China just already invested over years in infrastructure. And definitely, it was a huge positive catalyst in terms of growth. And I'm super happy to see this kind of plan happening in USA because I think that's more than the money injected in the economy. It's a great chance to rebuild a kind of American dream socially. I'm speaking about that, and I think that it's crucial too in this kind of populism rising everywhere on blah blah blah. I think that it's crucial that the American dream is restarting. I think it's a great occasion to restart that. Now we talk about this. In the title we talk about rotation. In the previous webinar, we just highlighted some stuff about rotation. Or just I put in some slides regarding this rotation. Okay, feel free, Jay, to have some comments. I just put that the huge inflow in the emerging, okay, roughly $310 billion, mainly due to the anticipation of a weaker dollar, and it was not the case at this stage. And definitely, this plan, I think, is pretty bull dollar, even if the debt of the country will skyrocket another time, but definitely it's quite bullish for the United States. Any comments, particular comments about the emerging inflow?
You know, Jacques, I have a lot of experience in emerging markets. As you know, that's where I kind of did the bulk of my early work and career. To be honest, I've been more bullish about the non-US developed markets than about the emerging markets for 2021. And I think that rotation, I mean, my worldview is quite straightforward. We're going into a global economic boom, the likes of which we haven't seen in 50 years. That leads to a great rotation from U.S. to non-U.S. leadership. So the U.S. has been the leader for the last decade. I believe that's changing from growth to value. Tech and growth has been the leader. That's in process of changing. And that's been really important here in the first quarter to buoy the markets more broadly. And we're going to have a bear market in U.S. Treasuries, the first in 40 years. So the marketplace is awash with regime changes of multiple natures. We talked about politics, markets, the rotation. And I think when you look at emerging markets and you compare today versus the past, you have to appreciate the rise of China. And as you said, I know you're expert there. I spend a lot of time there as well and focus on it intently. China is now the second biggest global equity market and global fixed income market. The money going into the fixed income market in China is massive because they have the highest yields in one of the strongest currencies. And so I think all this stuff needs to be put in context. And for me, I'm more keen on the value shift, in Europe and Japan in particular represent value. Emerging markets, I think it's much more of a kind of rifle shot approach than it is a broad allocation to EM, in my view.
Definitely, I think that we highlighted last time that I was not in favor of that about emerging debt in hard currency, definitely just to avoid to be too much in local currency. It's this kind of idea just getting well because definitely the dollar is not weak at all. I'm very afraid about a huge squeeze about because we have a huge positioning in the market short dollar. And definitely we have to take care about that. But anyway, okay, it's a very good point, Jay. China is just the massive emerging country. In this case, is keeping a huge part of this flow. Inflows into stocks, I think is obvious. Okay, 1.6 trillion is just massive. Those special comment, but I think it's historical in terms of global equity flows. I think that the chart, it's okay.
Yeah, Jacques, could I just say, I mean, I think it's interesting, two quick points. One, the dollar is really a tricky one. I'm actually, in my model portfolio, you know, we offer model portfolio delivery services here at TPW Advisory. And in our model portfolio, we have an allocation to local currency emerging market debt, not the dollar denominated. Yeah. And I'm of the view that the dollar, while it did have a good quarter here in Q1, I don't expect much further dollar strength, particularly against the majors as Europe starts to get its vaccination act together, and the divergence between the US and Europe, which is very wide right now in terms of vaccination and economic outlook. I think that's going to narrow as we go through 2021, and that supports the euro, weakens the dollar. And so to me, actually, it's contrarian, but we have a position in local currency emerging market debt. And then the point here on this chart is you think about who were the big winners over the last decade. We talked about the US and tech. Yeah. Risk parity, 60-40, balanced funds were the other huge winners, right? And I think one of the most dangerous statistics in financial markets today is the last 10 years performance of 60-40 funds in the US, which was about 10% per annum. Going forward, it's going to be 1 or 2% per annum. And so I think that spike in money going into equities is in part driven by all that capital that went into the balanced risk parity 60-40 now needs to kind of reallocate away from fixed income and into equity.
I am fully agree with you. That's why in Get Advisory, we have a kind of endowment style approach. I think that's, I've selected a very interesting chart at the end on just, it's in line what you mentioned about the danger in the 60-40 asset allocation, definitely. And now this chart is very clear. We back to the record high in terms of equity exposure, mainly the debt. It was just in favor of the debt. The equity just as overall allocated versus debt. On the cash side, of course, just decrease a little bit. It's a well-known chart. It's just highlighting that now we are close to the record high in terms of equity allocation. That's why it's important that not only to think in kind of 60-40 asset allocation. Now, in duration,
I would. Sorry, Jacques. I would just say that I would expect this chart to continue to go in the direction that these three lines are pointing. Equity is going to be significantly higher over the next 10 years. Debt is going to be lower, and cash is going to be lower. I would just point out to the audience that in the United States, the money market funds are totaling $4 trillion. Yes. Money market funds, $4 trillion, yields absolutely nothing. And so I would expect these kind of charts, equity going up, debt and cash going down. Yeah. I think that's the play in the setup for the next 3 to 5 years.
Okay, clear. I had these charts because definitely it was one of the comments that we did last time, is just to say, hey guys, on the US bonds, be short duration, shorter duration, or longer duration in European due to the ECB game and so on. Definitely it's already what's happened, okay? The low duration just receive, I should say, more flows than the longer duration. Do you think that it's this kind of allocation in the curve will continue, meaning that kind of a more more important steepening of the curve in the US?
Yeah, and I think that's exactly been, one of the drivers to the value trade, right? Has been the steepening of the yield curve, really helped financials, which have been really struggling, particularly in Europe. And I would just point out that in the first quarter, TLT, which is the U.S. Listed long duration U.S. Treasury bond ETF, was down almost 15%. Versus ACWI, the All Country World Equity Index, up about 4%. So it was a massive spread of performance. And if you were shorter duration or short duration, either way, that was definitely the right call. And I think both of us have been recommending that and have been positioning in our respective portfolios to be definitely underweight at fixed income and short duration, and I think that continues.
On long steepener, definitely, and I think that this is obviously this steepening of the curve just fuel the inflows in banks. Okay, after I have a huge doubt about this kind of inflow when we have a bear steepening. When it's a bull steepening, I understand that it's good for banks, but a bear steepening, due to my background in bonds, I am quite skeptical about what will be going on for the balance sheet in terms of in bank if you have a huge bear steepening. I want to say it's not good at all for anyone at this stage. These charts, it's I'm sorry, I draw my own comments on this. On this is just for me. It's for an European guy, okay. It's just scary when I'm seeing the curve of the M2 growth. It just okay. It's the Annapurna, I should say, on the Everest. What you think that this chart will continue on the upside? If I understand well your positioning, we will continue to climb.
Yeah, I think I've got one comment about the Fed and then one question actually for you, Jacques. The comment on the Fed is I think the Fed has been extremely clear And I have a different point of view than many in the fixed income markets in terms of the Fed. I believe the Fed has been abundantly clear. They're going to be data dependent. I would much prefer data dependency than dot dependency. Okay, so to me, I think we have a much clearer sense of what, when, and why the Fed is going to move.
Yeah.
And as investors, that represents clarity. And I'm happy to have clarity as opposed to a dot plot that can change at any point and is effectively meaningless. I never really understood the dot plot mentality. Maybe it's because I'm more of an equity guy than a fixed income guy. So that's my view on the Fed. Data dependent, very clear, very firm, and let the long end widen out. Hedged yields for euro and yen-based investors are better than they've been in 5 years. There's going to be a lot of supply of U.S. Treasuries, but I do think on a global basis, there's going to be a lot of demand. And so while I do think the 10-year is going to go towards 2% as we progress through 2021, a view I've had since November, I think we've gone a long way to recalibrating where people thought the 10-year was going to end, and we've done it without causing a dramatic sell-off in equities. I think that's very constructive. So my question for you, Jacques, is money supply is one thing, but what about the velocity of money, right? In order to get inflation, we need to have the money moving. And so you can show the chart of that money supply spiking like crazy, but if you were to show the velocity would be on the floor. It's completely dead. Money is not moving.
This is a drama. It's for me. It makes me nuts. Okay, because definitely we talk about the importance of the money supply from every central banks. Okay, but I am very happy that governments just take the lead now, because definitely now when we are seeing this kind of charts with a huge, massive money supply growth with no velocity at all, it's just a huge. This is why you have an imbalanced growth between the super rich and the other people. There is no velocity in the market at all, in the economy. The velocity is a kind of blood pressure in our body. Okay, if you have a blood but without blood pressure, you are dead. This is. I am not a doctor, but I think that's it.
Dr. Jacques in the house.
No, but definitely, I'm super serious. But definitely, it's the velocity is crucial. What I am just scared a little bit is if Mr. Biden just succeed in his plan. I think that it's a good point to start to talk about the transition. Okay, we are in the COVID space, we are in vaccination, but we are close, mainly more in US. I think you are, on your side, you are too optimistic about what we could do in Europe. Trust me, I am. We will see, but definitely you could experiment the transition. I think before the summer or around the Independence Day. Okay, meaning that if we have a money supply with a restart of the velocity due to the success of the plan of Biden, due to an improvement in the consumptions on the big way, I think that I'm a little scared about the inflation. Okay, because during many years, central banks just try to experiment better things to revive the inflations, but when the process is starting, it's sometimes difficult to calibrate the jump. This is one of my concerns. If Biden succeeds in the transition, if the herd immunity is established in US around this summer, I think it's challenging, mainly because I have some other charts. I will see after. I will jump in a very interesting point for me is the excess saving. We have the same stuff in Europe. your point in the savings, because I have the charts, impressive, plenty of trillions of savings, and I have another chart. This is my chart. I'm sorry, I put my comments on. I thought I love graffitis. That's why. Okay, and it just I'm quite skeptical in terms of savings if we dig in detail about what are the components of the savings. What is your thought about that?
You know, I think, to be honest, Jacques, you've done much more work on this than I have, so I'm going to defer to you. My own feeling is that inflation is a big question in the market. I personally think it's a misplaced question.
Okay.
It's not something we should worry about.
Okay.
Higher interest rates are good. Yeah. They show that the vaccination process is working. They show that confidence is returning. They show that the economy is going to recover, that earnings are going to recover, and all that I think is good. I do not believe that inflation is going to be anything but transitory. We will have higher headline inflation in the U.S. over the next several months, perhaps as high as 3 to 4 or even 5% headline CPI numbers. But we need to pay attention to what the Fed cares about. The Fed cares about core PCE. That's much more sticky. It doesn't move anywhere near as much as the transitory headline inflation will move. And I believe after the summer, after we get through these next 3 months, when a year ago we had COVID and inflation numbers were negative, after we get back into kind of more normal conditions in July, August, September, inflation is going to come back down, and I don't believe it is going to be a problem. If you don't have all this huge money saved up, which I think is your point, it's not going to create a super giant surge in demand that is going to throw things off kilter. But look, this is why, as I mentioned, to me, we're in uncharted territory, right? The economic environment that we're in, the political environment, is something that we haven't really seen in 40 or 50 years. Most investors today have never invested in an environment like we are in. And so you have to be careful, you have to be humble, and you have to be somewhat aware, certainly when you think about sizing and positioning within a portfolio, you know, these possibilities exist. My own view is that the inflation fear is misplaced. Bonds are going to move towards 2%. Demand is going to be there. We're in a bear market for treasuries. We've seen the low in rates, but I think equities are going to respond reasonably well, particularly outside of the U.S.
Okay, clear. It's my concern is just I dig a little bit in details on the forbearance, on deferrals and so on are in the savings. On this is I'm just a little bit afraid that when I'm seeing some investment bank just pushing the idea that, hey guys, these savings will become consumption. It's just that this kind of simple rule could be challenged by the reality of that. Well, you will restart in the US your economy full run. All the forbearance, all the deferrals will just stop. And guys, you have to pay all your rentals or your bills, okay? And because your bills was not withdrawn, there is no write-off. It just postponed. There is a difference between a withdrawal and to postpone something. I just had to be afraid that kind of I put this in the charts that the zombie army. Okay, we have the retail army, now the zombie army could just pump up, say, hey guys, we are very angry on we will no pay, we will no repay what you have to pay on bye-bye. Your provision for losses are becoming pure losses. I am just this transition for me, just a kind of gray zone. I am not very confident. Just to
where is that? You have that chart on the zombies, I think. Where is that? Because I just want to ask you about that. Yeah, there you go. There it is. So look, I mean, to me, the problem with this idea of like that there's tons of zombie companies that are going to fall apart once we reopen, which I know is a big concern in Europe, and I know you've written about it extensively. My question is, high yield issuance is off the charts, right? High yield issuance in the US in Q1 was a record, been very strong in Europe. I don't know who are these companies that are going to collapse. And I'm sure there are many, but are they publicly traded companies that are not able to access the high yield market at a time when the high yield market has got record issuance? Yes. I don't really see the problem here. I really don't get it.
But this is my main concern on us. I think that's one of the explanations of the underperformance of the Russell 2000. It's just that small caps they have not hold the capabilities, even if they are listed, to just raise money as quick as possible. Mainly, it's not the case for big companies, even if they are ranked as junk. But for small cap on small companies, I think it's I'm more afraid in this part of the field, I should say. But it's a good point. Okay, it's the new issuance on the primary issuance at the beginning of the year just record high. On definitely, perhaps they will have some enough cash just to survive to the transition in the ocean. I think it's a good point. It's my concern because I saw many developers with a huge amount of debt, with no cash flow at all, due to the deferrals or due to forbearance. And now, if we reopen with no cash flow, I'm sure no repayment, we will see. But agree with you, they had the opportunity to raise bonds to raise cash through bonds. It's a good point. I want to let some question to the audience. Just I would like to. Okay, I put this chart because I love this one. I love this one. I love the comments.
It's a great chart.
Yes, and it's not my comments. I regret that, but usually, trust me, it's huge.
Yeah, is that Ed Yardini? Is that Yardini stuff? That looks like a Yardini chart. Yeah.
And I love the charts. And definitely, it's the margin debt is huge. Okay, there is a comment about Bill H1, but definitely, it's. I think that I think we have to bear in mind that there is a leverage in companies due to what you mentioned, huge issuance of bonds at the beginning of the year. But you have huge leverage also in the equity market. And when I'm seeing what's happening in Credit Suisse, I am not quite comfortable about banks if we have an issue in terms of disappointment at any scale. I'm not talking about a huge disappointment, just a delay about the transition. Meaning, for example, okay, who knows? And when I'm seeing this kind of charts with the huge leverage, it's the other charts.
Can I just? Sorry, Jacques. Can I just make a quick point there? I actually have a slightly different view. And my view is that the market has done a great job of pricking bubbles over the last 6 or 12 months. If you go back and think about the FANG stocks, everybody worried about how expensive they were. They peaked relative to the S&P 6 months ago and have been underperformers. If you think about 2 months ago, we were worried about GameStop and the Robinhood Bros and all that stuff. Disappeared without a trace. I know GameStop has gone up, but the mentality has gone down and has disappeared. If you think about Bitcoin, Bitcoin has had a 40% correction in the first quarter. If you think about ARK and clean energy and all the innovation stuff, the thematic stuff that you and I do a lot, those ARK's flagship fund fell 30% in 6 weeks. So, and then we pricked, as I mentioned, the bubble in U.S. Treasuries, right? With people predicting the 10-year would end 2021 at 1.2%. It was the biggest mistake of the consensus sell-side calls in 2021. We've now fixed that. Almost everybody is at 2%. So to me, in the fact that we had this drawdown with this hedge fund liquidating all these positions, to me, that is a perfect sign of a market that has cleared out all the uncertainty, and we are now very well positioned to move higher as we go into one of the best seasonal parts of the year, which is April and May, in a very strong earnings season. So to me, the market has done an admirable job of pricking all these little bubbles and still staying up. The S&P is up 4, ACWI is up 4, ACWI ex-US is up 4, while we have adjusted all these different things. That to me is a sign of a very strong market.
Okay, you mean that we have a kind of LC rotation for the market?
Yes, the breadth and the rotation from growth to value, market is kind of trading off each other.
Yeah.
So technology is down, the S&P is still up 4, but the equal weighted S&P, which is something we have in our portfolio, I have no S&P exposure. I have equal weighted S&P exposure, and that vehicle is up 12% year to date, triple the performance of the S&P. And that to me is a sign of a very healthy market that can allow for those rotations while gradually moving higher.
Yeah, we have the same process. All our strategy are equally weighted. I don't want to put some bets inside your strategy. The goal is to design the right strategy on the right topic, and after to select the right stocks. But definitely, we don't want to have a kind of selection effect to just putting 3 stocks at 10 or 20% of the fund. I put the charts just to highlight that definitely perhaps that was one of the reasons why all the GAFA and so on just correct a little bit. Just the e-commerce adoption. Okay, the COVID just accelerated so much the adoption. It just is the chart is coming from McKinsey. Okay, that's why just not investment bank, coming from an investment bank. But definitely, I think it's quite appealing to see the X factor in terms of adoption. For me,
yeah, I would make if I could make just one point, Jacques, because I think this is a great chart. I love this chart. It's got a ton of information, and you're absolutely right. The work from home stocks peaked 6 months ago. Zoom, Peloton, etc. They're all down 30, 40%. The market, it's important, we know this, but it's important to remind our viewers, the market is a forward-looking discounting mechanism. And so for me, I've been writing about how vaccinations and rising rates are kryptonite for big tech, because vaccinations end the work from home. And yes, we're not there yet, and people have not yet gone back to the office, but we are going in that direction. And the market, as a forward-looking discounting mechanism, is pricing that in. And so it makes perfect sense that while we've had this acceleration, this is now actually bearish for technology going forward, for the dominant tech players. I wrote a piece a couple weeks ago saying, down with domination, up with innovation. And that's where the thematic interplay comes in my view.
Yes, it's a very good point. I think that this chart just highlight what you mentioned, the difference between the domination and the innovation, I should say, on the description, because there is innovation on description too. And I think it's quite important to bear in mind that the COVID accelerates so much the adoptions that the valuations became so rich in so few times that I think we have to bear this in mind. We're close to finish. I would like to just highlight this because I'm reading so many comments. As you mentioned, we are starting to jump in a new quarter. And also, it's a very good quarter in terms of seasonality for the equity market. But why is disturbing is that we have huge in CNBC, whatever. Hey guys, you have super fantastic figures, plus 20% year on year and so on. Yes, but there is a difference between the percentage on the absolute. And also, it is the left hand slide on the following slide. The time horizon is important too. If we compare to with the base effect with last year, we were close to the collapse in everything. Okay, and of course, to have 20-30% of increase in terms of percentage is not easy, but it's quite common. If we compare with the 2-year change, maybe in 2019, you see that it's not at all the same. Okay, and is the same for the sentiment. I took the it's just a new slide because it's just fresh of today. The Bank of Japan usually charts just in terms of bonds in the sentiment in Japan. It's of course bonds back, no problem. But we are far away from the 18 or 19 level. Just what your, because I know that it's important for the finance to have very positive announcement, but at one stage, if we are just focused on the percentage, just forgiven what's happening in the absolute term in terms of figures, I am quite skeptical about the end. When the recognition day, we say, hey guys, okay, it's plus 30, but we are still 10% over 2019, but we are on record high on the stock market. But
I think that's, I agree completely, actually. And one of the things, I think it's very tricky, and it really frustrates me that, when you pick up the newspaper or read Bloomberg or Reuters or what have you, everyone's talking about, we're up 80% over the last year, and forgetting that it's completely a meaningless number. I mean, it makes headlines, but it's irrelevant. It's dangerous. So I agree with you completely. I think you need to look back 18 months, 24 months, and try to get a sense of where we are versus where we were. And I just, as an illustration, XLE, which is the oil major ETF in the United States, it's up 29% year to date, okay, versus ACWI up 4%. Over the last 2 years, it's down 26%. So I agree with you completely. Over the last 2 years, the S&P is up 40%. ACWI ex-US is up only 20%. And so I think a lot of this is understanding kind of where we were and where we are and where we're likely to go. And to me, skating to where the puck is or where the puck will be, as opposed to, I guess, where it is really the challenge investors have today. And to me, where the opportunity set is in that golden age of asset allocation, coupled with integrating thematic investing into one's global multi-asset portfolio. I know that's something that you do at Gate.
Yes.
It's something I'm very focused on at TPW Advisory. And to me, that's where the alpha generation is going to come from. Is going to come from the thematic side and the asset allocation side.
Agree with you on definitely real thematic is not the purpose of our webinar today. Honestly, I committed a post in LinkedIn about the ARC X, the new ETF produced by ARC about the space
yes,
stuff and so on.
I saw that.
Yes, I was very stomached by the number of views, more than 17,000.
Wow.
And it
awesome.
Yes, it's massive. And it just demonstrated I am an aeronautical engineer. That's why I know the subject. Honestly, when I'm saying this kind of constructions, it's just a disaster, or is appealing by the title. But when we dig in details, hey guys, there is no matter. Amazon, I found all the GAFA on the bat, Baidu, Tencent, and so on. Okay. As I know, I have no mailbox on the moon, neither on Mars. Okay, perhaps there is some new kind of stuff that I don't know, but I think that it's strange. It's the same in infrastructure. It's just I did details in some ETF. One is the ETF most well known in the States. The weight of utilities is 40%. I understand that infrastructure utilities is a part of, but 40% is huge. In other ETF, we have 30% in real estate. It's quite brilliant to put this kind of amount in infrastructure thematic, because when you have a drop on the yield like we had in previous years, of course, these components of this thematic will just act as a booster in terms of performances. But real estate, they have no clue at all with the infrastructure. It's just a mess, or it's misleading. It's just to highlight this. It's after just I will pass this one. I liked it about the inflation. Why I am sometimes nervous about that is just because we are seeing that some central banks, this is coming from central banks, are seeing some skyrocketing level in terms of raw material prices. On one is important for me because I know that I love China. Not every day, but I think it's a very important topic to assess in a way. This is very important charts because the inventory in terms of progression of growth year to date is very slow in China, meaning that if we have skyrocketing demand, okay, with the low level of inventories, will conduct to, for me, it's obvious, a huge spike in inflation because the bottleneck in supply chain is so huge. It's cool, just spike in huge events in inflation, perhaps transitory. But when I'm seeing this low level of reshaping in inventories in China, or mainly China is the first builder of things, I should say, or manufacturer in the world. I don't know.
Yeah, I actually, this is a great chart, and it's an example of one. Yeah, if we could leave it there for just a second. You don't see this kind of work very often, so kudos for you to pull it out. I actually have a slightly different view.
Okay.
I see China having some inflation as being bullish for global growth, particularly over the medium term. Right? If China is the kind of the manufacturing price setter, the thing that we don't want in the world is deflation.
Yes.
Just like we talked about higher interest rates. Would we rather have higher interest rates or lower interest rates? I thought we've been complaining for years about negative interest rates. Now we're finally starting to have higher interest rates and we're complaining about higher interest rates. I would much rather have higher interest rates because global growth is recovering, as you touched on, bull market versus bear market steepener. And so for me, China, the fact that the renminbi is appreciating slowly is a good thing. The fact that China is going to have some inflation, a limited inflation, is a good thing. It provides an umbrella for the rest of the world's manufacturers to produce and to raise prices and to grow. It provides an opportunity for producers in the US and in Europe and Japan who are more expensive to maybe compete a little bit better with China. And I think it does drive more of this regional integration, particularly around the production platform basis that I've been looking for years and talking about for years. I think it's manifesting. And so China with a little bit of inflation, a stronger renminbi, to me, that is a sign of a little global inflation. And given all the debt we have, I think we would much prefer a little inflation than deflation. Obviously, the risk is that a little inflation becomes a lot of inflation. I don't think that's going to be an issue because of demographics, the continued expansion of innovation through technology, et cetera. So for me, I look at this and I say, I think a little inflation in China is a good thing.
Okay, and just to clarify my positioning regarding the audience, but you know my positioning, Jacques, I am really like you in favor of higher rates. For me, just an inflation, we need inflation. It's just my concern, it's coming from a bonds market. when inflation is starting, usually it's like a tiger out of the cage. Okay, it's difficult to cool down the stuff. At one stage, the central banks could face to what a credibility moment. Okay, a kind of Minsky moment. Okay, you are there now. You have to act on to proactively act or to do something if the inflation go to 3 or 4% or 5%, even on a short period of time. On the credibility of central banks are just crucial for the entire market. This is just I am 200% aligned to you. It just say we need inflation, we need higher rates. Point. It could be a golden hedge for equities. Agree, but in this transition, if we have a huge spike in inflation, so what will be the coherence? What will be the positioning of the message coming from central banks? Or what? I don't know if their credibility will survive at this kind of events. Just my question.
Yeah, and that's why, to me, as I said, the Fed has been abundantly clear. It's going to be data dependent. And I think that's exactly the way to approach this environment. It will be data dependent. And when we see the data where inflation gets to X and Y and unemployment gets to, whatever the level is that they've made clear is the level they're looking at, they will act. I think that's clarity. I agree that the bond investor the famous bond vigilante may well test the Fed. But my expectation is that is going to be handled fine. And I think, the question of the Fed is that the Fed has unlimited ammunition, right? Because interest rates at the short end are zero. So central banks have all the ammunition they could possibly want to dampen inflation when the time comes to do so.
Yeah. And it's okay, good point. I have nothing more to say about your comments. I will finish with this one. We have questions. That's why I want to just. I am a huge fan of the underlying allocation. Okay, I am a huge fan about that. I am a huge fan about the thematic allocation, real thematics. Okay, no some strange packages, and on definitely this chart just amazing. Okay, we are an all-time low in real assets relative to financial assets. It just I love to make strategies in asset allocation listed products like ETFs or thematic and real estate, yes, or private equity, private debt, and so on. And I think that's, or even vintage cars, paintings, and so on. And I think that's, we are
NFTs.
Yes.
Any NFTs?
Yeah.
Not yet, huh?
Yeah. I love the charts because just highlighting really what's happening now. It's we need in asset allocation to assess the real assets. I think it's mainly what is still the case in private banks at this stage, because they want to separate for plenty of reasons, mainly some bad reasons. I think we need to mix both. I think that these charts just okay, guys. If you don't understand that, you have to integrate private equity, some thematic, even some thematic in private equity. We are working in a project about that with a very dedicated thematic in private equity. I think it's crucial. And I think I wanted to finish with this.
Yeah, I think oh, I'm sorry.
No, go.
Yeah, can I? Yeah. No, I love the chart. It's brilliant, and exactly for guys like us, global macro multi-asset, it's exactly the right approach. On your comment about private equity, I did note that Blackstone has been talking quite positively about thematic investing as a way to generate alpha. And you see MSCI, for example, producing 16 different thematic indices, because I do believe that the pension fund and endowment community is going to need to find new sources of alpha, given what's going on in the fixed income markets. And thematic investing is a vehicle for those institutions. And as they become, and they fit perfectly with the timeline, right? They're long duration liabilities, they're long-term investors. Thematic plays out over long term. It makes a tremendous amount of sense. I mean, from the TPW angle, we're 100% ETF focused and public market focused, but there are ways to obviously play commodities. And I just note that GSG, which replicates the Goldman Sachs Commodity Index, is up 12% year to date versus the ACWI up 4%, but is down 12% over that 2-year period versus ACWI up 25%. So it makes the point that you're making here, that real assets have a lot of upside, particularly given the fact that there's been such a lack of investment, particularly in the metals and the mining side, which suggests that price is going to have to deal with the supply-demand imbalance that's likely to come over the next couple of years.
Okay, Jay, to finish, we have a question. We have several questions, but I select one. It's, I'm reading it. With so much leverage, so much debt, money velocity at all-time low, aren't the risk of significantly higher rates, 10 years, 250, 3%, very serious concern or risk? Or
yeah, I mean, to me, I do think the markets have adjusted, as we touched on, right? The consensus on Wall Street at the end of last year was that the 10-year Treasury would end at 1.2%. I wrote in November that this was the single worst call that the sell side was making. My own view was 1.75 to 2% at the end of this year. I stand by that view, and most of Wall Street has now shifted to a view of 2%, give or take. How fast we go from here to there, we've made up a lot of ground. And as I pointed out, equities are still up 5% in the quarter. I think that's been an admirable job. We saw the Biden job plan, $2.5 trillion, 10-year Treasury rallies, okay? So a lot of this is now, I think, in the price. The next challenge is the one Jacques mentioned. We are going to have significantly higher headline inflation in the next quarter. How markets deal with that is going to be interesting to observe. My own view, as I pointed out, is that the U.S. Treasury market at 1.7% compares very favorably to a 10-year Bund at -3%, or a 10-year JGB at whatever, 8 or 9 basis points. And so I think there's, on a hedged basis, there's going to be plenty of demand for U.S. Treasuries. And it really is going to be a supply-demand issue, because the supply of Treasuries is going to be $1 trillion or $2 trillion above prior years. So there is going to need to be demand, and I believe that will happen. And so I don't expect to see the 10-year blowing out to 2.5 or 3% over the course of this year. Over the next several years, I think that's quite likely.
I am more extreme than you about that. It's just to answer to the questions raised by Alexandre. At the beginning of the year, I had 1.65, 1.70, roughly the dividend yield of the S&P 500. Okay, as a target. After that, 2, but if I dig in details about the ISM, the PMI, or whatever metrics, okay, we should be at between 3.2 to 3.3% in the 10 years yield. We just back to 2018. In 2018, Q3, we were at the 10 years just reached 3%. On the Q4 in 2018, sorry, was not a good souvenir. But definitely, I'm still convinced that we will see 2% for sure. But if we break up this level, I think that if we continue to have this kind of growth on the absolute level in the PMI, in the ISM, in the consumption, in the investments, in the rebuilding inventories, I think that we could have a jump of the US 10 years to 3%, mainly also due to technical events just happening at the end of last month, just now, the end of the SLR. The end of the SLR just now will force banks to put some capital face to their investments in treasuries. Last March in 2020, the Treasury just put this SLR in place just to say, hey guys, if you buy some treasuries, you have $0 to put in capital. Now it's no more the case, meaning what kind of game we play the banks during all the huge issue, the auctions needed to finance, I should say, all the deficit in the US and so on. This is a question, but that's why I am still more aggressive. I think we will see sooner than later 3% on the US 10 years. It's not, for me, a kind of drama, because we were in 2019 at this level. Okay, it's not 100 years ago, but definitely it's we could have this kind of move if the economy is starting to booming.
Jacques, I have one quick question, and then I know we probably have to get to another question, and then we could close it down. But yeah. I'd make one observation and then one question. The observation is that I've read that the U.S. Treasury now represents 65% of the free float of yields over 1% in the global marketplace versus 35% a couple of years ago. And so that's the observation. The U.S. Treasury is the only game in town. And then my question is to compare these inflation numbers and a possible Treasury rate to several years ago. I think one has to ask, what was the Bund yielding at that same time period? Because I think we have to remember there is very little in the way of safe asset yield over 1.5% going to 2%. Yeah. So I think we have to think about what were the alternatives 2 or 3 years ago versus today.
Totally agree. Definitely, on my humble view, the European market on bonds is completely disconnected from the reality, from everything due to the ECB. When I'm seeing the 10 years yield in Greece, on Italy, it just can make me nuts. On definitely, it just no correlation with the reality. That's why I think that we need to, all the banks has to fire their economists in Europe, because there is no sense to have a guy explaining what's happening in the economy when we have this kind of rates completely disconnected of any reality in Europe. But the big issue is that if the bonds back to zero, just to zero, okay, it could be huge, a massive effect on the bonds portfolio, meaning in Europe. Even if pension funds in Europe are just crying and shouting to have higher rates, because their asset allocation due to just they are forced to have this kind of asset allocation due to regulation, is just forced to be invested in zero or negative yield, and they have to pay. And you mentioned the demography, you have to pay more and more retired people on pensions with zero yield environment. It's just schizophrenic. We have a huge issue on the bonds market, definitely, if there is any squeeze due to, for example, a less supportive ECB, or perhaps some metrics in Germany not going in the right way due to the lack of efficiency of vaccination stuff or vaccination policy and so on. At this stage, we are in difficult environment in Europe regarding vaccines. Okay, Jay, I think it's time. We talk a lot, but I hope that it was interesting for our audience. And thank you a lot for your expertise on your world. I am very happy that we were not aligned on all topics, but we are agree to not be agree. That's why I think it's a value, I think, for what we share together. Thanks for your time. Thanks for the audience. Thanks to Quantilia to organize this event.
Thank you very much, Jacques and Jay, for your time for such an interesting discussion today. We are going to publish, as usual, the replay of this webinar on our YouTube channel, and I hope that we will find you both for our next webinar together. So it will be also interesting as usual.
I have just a question, the last one. Jay, could you give me 3 thematic for the end of the year just to play this transition?
Sure. I think I'm very interested in carbon. I think one of the things that was missing in the Biden jobs plan was commentary on carbon and carbon pricing. And so I expect perhaps at the climate summit that this will be a topic, and I think there's a real opportunity there. I also think it's less volatile than some of the other thematics. And so I like not only marrying kind of old, like XLF and XLE with FinTech and clean new tech. Marrying those two allows you to play the value and offset the volatility of the clean tech space. So I like that. And then secondly, I like mixing between the more aggressive thematics and the less aggressive. So carbon is one that's less aggressive. I also think that FinTech is very, very interesting here. The melding between traditional banking, FinTech, and crypto. So I think FinTech is very interesting. And I also think that the third one is infrastructure, which I like a lot. I know you have your own infrastructure thematic, Jacques, that you've created, which is very interesting. There is thematics in the US, as you pointed out, some of them perhaps not as well put together as others, but I think that opportunity set is also significant. And one of the things I would just highlight is that today, 2020 is not at all like 2000. We have a very different environment, particularly around climate, around innovation, that is government supported, fiscal supported, activist government supported with the private sector. And I think that creates a paradigm shift, which thematic investing is the best way to access that alpha generation capacity.
Yeah, agree. On our side,
what are your 3, Jacques? Yeah, what are your 3?
2 on listed stocks, and 1 in private equity. It's just to be aligned with the on-demand style that we have in Get Advisory. The first one, obvious, is US infrastructure. The second one is decarbonization in China, mainly in China. That's you point out the right stuff. In US is not the first topic, I should say. In Europe, we are close to nowhere about everything. On China, it's already in the first place in the new 5th-year plan. Or mainly now there is 15-year plans because they just strengthened the duration of their plan. Now there is no 5 years; it's just 3 times 5 years. On decarbonization in China is a huge topic, and we have already a thematic on that. In private equity, I think that the hydrogen will be the next topic, because if you want to decarbonize, if we want to electrify some transport mainly, hydrogen, it's a prerequisite to go in this way for mainly heavy transportation, mainly trucks, mainly boats, mainly tankers, or even airplane on commercial aircraft. This is my three main topic.
Excellent. Thank you, Jacques. Thank you, Katerina. Thank you, everyone. It was wonderful.
Thank you very much. Thank you, and see you soon.
In 1 month, have a great Easter. Take care. Be safe. And we'll be back on, I think, with Jay. It's a good idea to do another time with a new topics on.
My pleasure.
Believe me, you have to very be focused on the subject of this new topic, because usually Biden just talk one day before, or the Fed or something like that. Just be focused on the subject, guys. I think that we are pretty brilliant to just capture the essence of the moment. Okay. Have a great day. Have a good Easter, and stay safe.
Thank you. Thank you.
Thank you very much, everyone.
Stay safe.
Bye-bye.
See you soon. Bye. 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 Thank you.